Welcome, everybody. Glad you're here. Nothing going on in the world and the economy, but it's good to get together anyway. I'm Glenn Hubbard. Thank you for joining the Chazen Global Markets Update. Our wonderful guest is Abby Joseph Cohen. What could I say about Abby? I could say she's a Barron's investment maven, and that would be true. I could say that she's one of the 100 most influential women in finance, according to Barron's. That would be true. I would put an asterisk and just say one of the 100 most influential people in finance. I could say that she was a legend at Goldman Sachs when she was there as a chief U.S. investment strategist, president of the Global Markets Institute. I could say all those things, but what I'm most proud of at Columbia is that you're here as a professor at our school. So before we begin, please join me in welcoming Abby Joseph Cohen. And one quick announcement, lest I forget, when we're done, lunch is upstairs in the alumni suite. But remember the part when we're done. It's there. Okay, so Abby, let's start out just very big picture in the economy. Where are we now in the U.S. and global economy and in markets?
Okay, well, Glenn, first of all, thank you for that lovely introduction.
My pleasure.
That's why I always accept your invitations to speak. Where are we now? Well, if you look at the stock market, or if you look at the economic data, we're in a very good shape. We're in a very good place. Economic growth right now in the United States, real GDP, is tracking at about 3%, adjusted for inflation, keep that in mind. We have very low unemployment. We have very good job creation. It has slowed down a little bit because we have already reestablished the jobs that were lost from the pandemic and added another 7 million brand new jobs. We have inflation that has come down from about 9% to roughly 2%. So I would say the situation is actually quite good. And oh, by the way, for all of you business students, corporate profits are at a record level in the United States. Helps explain why the stock market has had absolutely phenomenal performance this year and last year. We are up at extraordinarily high levels, unprecedented, and the rate of change has also been extraordinary. So the reality is pretty good, and the United States, relative to most other economies, is also extremely good. Unfortunately, many of our friends in Europe are not experiencing the same kind of economic performance that we have. There are concerns about Germany. There are concerns about other parts of the EU. There are also concerns about Asia. And of course, China is the very big question mark. Now, I can go on and on, but I'm going to stop here, Glenn, and see where you'd like me to take this.
Well, let me probe this Goldilocks scenario a little bit. So, do you think the markets are fairly priced, ahead of themselves? How do you, given the scenario you've outlined?
Okay, so fairly priced or ahead of themselves, and the answer is yes.
Okay.
Because there are some parts of the market, the equity market in the United States, that I think are ahead of themselves. Many of you have already heard about the Mag 7. You've looked at it yourselves. You see that there is this wide valuation gap between a very small number of large capitalization stocks in the S&P 500 versus the rest. In fact, it's about a 10-point gap in PE ratios. That is really quite extraordinary. If you go back over history and you look at dispersion of PE ratios, to have that wide a gap is really quite unusual. Now, one could argue that these are unusually successful companies. I would say, yes, they're very successful, but the good news is largely priced in those categories. So when you ask, is there still value in the market? I would say there's value, but not necessarily in the stocks that have been the leadership performance stocks. I also worry about the momentum. We have seen many investors really focus in on momentum. And there is a correlation between the performance of the Mag 7 equities and things like cryptocurrency. We also see, of course, the momentum in things like meme stocks. And as a value-oriented investor, that worries me. I'm concerned about things that are moving ahead on the basis of enthusiasm rather than the underlying fundamentals.
So putting all my life savings in Truth Social and GameStop was not a good idea? Is that what you're saying?
It might have been for 20 minutes or so,
Okay.
if you knew when to get out.
Okay.
But diversification clearly is an important thing to
Okay,
follow.
I want to keep on the theme of this Goldilocks scenario and pivot to the Fed. So if I believe the state of the world that you outline, why the heck did the Fed cut rates by 50 basis points? Do they know something we don't know? Is there something else going on? How do you see that?
The 50 basis point cut is something that had been widely telegraphed in the market. And I believe one of the reasons the Fed ultimately decided to do 50 as opposed to the 25 that some people have argued in favor of at the FOMC, which we now know about because the minutes have been released. I think they opted for 50 because the market was expecting at least that much. And there was concern, I believe, at the Fed that they were behind the curve in the marketplace. I have never felt that they needed to do very much more, but they didn't want to have this weird-looking yield curve, and they didn't want to have a situation where investors kept saying, you need to do something. They've now done it. I believe that based upon the data that we're now seeing, they may not do very much more. I certainly don't expect another 50 basis point cut. They tend to avoid, at least in the past, the Fed tends not to like to do things right around an election, so I'm not sure anything happens in November. But if I were to be forced to say, what is the Fed's next move? I would say it will be a few months from now, it'll be 25 basis points, but only if needed. It's not clear to me that it will be needed. We'll all see. We'll all find out together. I believe that this is an FOMC that truly is data-driven.
Yeah, I mean, given the economic outlook you outlined, and I certainly share, and given that inflation's still stuck above the Fed's target, over the next year or so, how much more room on the funds rate is there to cut?
The expectation on the part of many is that it could be a total of 100 basis points. So we've had 50, so are they halfway done? If we knew the economic data now that we'll be seeing 6 months from now, we could say something different. But this is an economy that I think still has legs. Consumers, by and large, are in robust shape. There are exceptions. We can talk about the fact that there are distributional problems, particularly middle-income, lower-middle-income families that are not doing as well as the average. But by and large, consumers are doing well. They obviously feel comfortable. The savings rate has gone down. They're spending like gangbusters. We see that business investment, I'm not talking about portfolio stock investing, I'm talking about CapEx, that looks good. The thing that I'm really focused on, because I think it will be a bit of a wild card, is residential investment, the housing market. It's the one area where we still see inflation hanging on. If you X out real estate, inflation is actually now below 2%. But we also know that there is a shortage of housing. So this to me is an area that the Fed will be looking at, because while we always talk about the importance of interest rates for the economy, where is it really important? It's really important in credit-sensitive categories like housing, and by the way, also autos, because most families finance their auto purchases.
Now, you and I are economists, so I want to go from Goldilocks to our worry closet. So tell me what's in yours. What are tail risks out there that people are talking about, maybe some that they're not talking about, that interest you for the economy and for markets?
My biggest concern, quite frankly, is the election. And this is not a political or an ideological statement. I am very concerned about the election for a variety of reasons. Number one, in the past, there has typically been a sigh of relief rally in all markets after the day of election. And that is because the majority of people see that their candidate won, at number one. And number two, it's over. I'm not convinced it's going to be over November 5th or November 6th. I'm very worried about a contested election, whether there is legitimacy behind those contests or not. We certainly saw that in 2020. That to me is very worrisome, and it's something that has international implications. And I don't believe that many investors here are properly focused on that. Now, what are the international implications? As you and I have discussed many times, we have a budget deficit, and we have a debt that needs to be paid. And who buys treasury bonds and treasury bills? Well, much of that is purchased domestically, but we also rely on outsiders, foreign participation in our treasury markets. And I will tell you that watching things on a trading basis, which I don't normally do, but watching things the last several weeks on a trading basis, when one of the candidates in particular makes comments that could be viewed as unfriendly towards the deficit or unfriendly towards the global economy, we are seeing rates go up. We're seeing some concerns in the currency market as well. So I am worried about the election and the consequences thereof. More importantly, the intermediate and long-term consequences of policy, depending upon who is elected, to me, could be very significant as well. And I can spend another 20 minutes, 30 minutes on that.
I want
or
to
a
probe
quick
on the
one.
election, but I want to know first, anything else in your worry closet, tail risks?
Also in my worry closet has to do with geopolitical risk from other places. The situation in Ukraine is not a resolved situation. I will paraphrase Ronald Reagan: the axis of evil between Russia, Iran, North Korea, with the movement of arms between those three countries, is very worrisome to me. And something that could be very destabilizing to the global economy, and something that destabilizes the global economy obviously can destabilize us. In terms of domestic, I'm not concerned about the consumer, although lower middle income households are feeling some duress, not as much as they were, but that is one issue. I mentioned residential real estate. Then there's commercial real estate, something that I know gets discussed in the business school quite a lot, particularly in urban areas. We have, in many cases, too much commercial real estate, and I don't think we've seen this play out fully. Why is that? Because the leases are so long, right? If you're talking about a city where the average length of lease is 7 to 10 years, we have not yet seen a lot of those leases reset. And if parts of New York City are any indication, it's not going to be a pretty picture for the owners of those buildings, those who have taken on the debt, or potentially for the people who have lent them the money. So to me, that is something else that needs to be watched.
Let me unwind each of those. So let's start with commercial real estate. Is your worry about regional banks or insurance companies, the transmission there? Is it through public markets? Where do you see the economic transition once we start marking to market more of the problems in CRE?
I think the problem will be largely in regional banks. Now that may sound strange because I just talked about New York City. And a lot of New York City real estate is not related to regional banks, but regional banks are not as well diversified as the major city banks. I'm sure you've heard the expression GSIBs, the globally systemic important banks. Well, those are the ones that do a lot of business here in New York and in other major cities, and they are being much more actively regulated by the Fed, by the control of the currency, and so on. The regional banks don't get the same level of attention. Just think about Silicon Valley Bank, which blew up a couple of years ago. And one of the problems there is that they had a totally undiversified portfolio. It was, Silicon Valley Bank, so their real estate was in the valley, but a lot of their deposits were also coming from the same companies. I do worry about regional banks in that regard. Post-financial crisis, the GFC, I believe that the United States and some of the other countries did a good job of tightening up regulation. But again, it affects mainly the larger names. And by the way, even this week, you can see that there have been some very significant banks that have been fined extensively for bad behavior. And I worry about that. Banks should not be behaving badly, not just because it's not nice, but because it puts at risk everyone else that's in their ecosystem of borrowing and lending.
You also mentioned geopolitics. I could think of 3 points maybe we should discuss. One is oil. So what are your thoughts there? I could tell stories about events in the Middle East and higher oil prices. I can also tell stories of Saudi Arabia's recent decisions and much lower oil prices.
Right.
How do you see that panning out and effects for our economy?
I am not a commodities expert, but looking at people who I follow, because they are really, this is a bad pun, they're digging into it. What the expectation largely is that crude oil prices that get so much attention in the media may bounce around a little bit, but ultimately they're about where they should be. So we're talking about $70 to $80 a barrel. Where the greater volatility is natural gas. I do not know, for example, what the impact on natural gas prices will be because of the storms in the Gulf of Mexico. It may very well affect it. We also don't know about the impact on natural gas prices because of the ongoing Russia-Ukraine situation. And by the way, there is natural gas coming out of the fields near Israel, which have been going into other parts of the Middle East. And if that gets cut off, which it has from time to time, depending upon the level of military activity near those fields, that is something that affects the countries being supplied, which include Egypt and Jordan and Lebanon. And so I think that that's something that generally is under the radar of many people, but could be of consequence.
Two other things that would occur to me that, based on what you said. One is equity risk premium. In the past, when we had much higher geopolitical risk, I'm thinking of the Cold War between the United States and Soviet Union, we had much higher equity risk premium than we see today. Another is the fact that a sleeper issue around the world, defense spending is probably going to have to rise and rise a lot. And all in industrial democracies that are already struggling with their budgets, which is a clear potential risk for business taxation and other things. How do you think about those two risks? And do you think market participants, if you think there are risks, are they focused enough?
You raise such an important topic, and it's not just the factors that you're mentioning, that is defense spending, and I agree with you. But we also have an underlying factor having to do with demography that will also create higher budget deficits. In the large democracies and in countries like China, we have an aging population. And in the past, what we know is that when you have a young population and a growing economy, you can basically grow your way out of a debt situation. Now, for those of you who've been studying this issue, you know that sometimes it's done in, I'll call it not a nice way, which is to bolster inflation so that you have the debt, but you can pay it off in cheaper dollars. One of the things that I think would be important is looking to see how these various countries, ours included, try to work against the debt, that is trying to make the debt smaller and smaller as a percentage of GDP by growing GDP, right? It's not the aggregate amount of the deficit or the debt that should be the focal point. It should be the deficit or the debt in relationship to ability to pay or the size of GDP. So how do you grow GDP in a non-inflationary way? And that to me is one of the critical elements that I look at when trying to think about good economic policy going forward. And I hate to say it, but the United States has failed pretty much in this regard over the last 30, 40 years. If you go back to the 60s, as just one example, 50s, 60s, and so on, what you saw was that we invested in ourselves as a nation. We invested in public infrastructure, not just at the federal level, but state and local, number one. Number two, we invested in science and basic research. A lot of that was funded by the federal government, but made its way down into universities like Columbia, where the work was done. And we also looked at the other area in which we need to invest. How do you bolster productivity of an economy? That's the most important key, because the productivity growth of an economy tells you how the economy itself can grow, right? So it's K, capital for infrastructure, research, investment dollars, and also L, labor. And we have not been investing as heavily in labor, education, retraining, reskilling, as we did in previous decades. And this is very worrisome to me. And I think what we need to see are economic policies that move us back in that direction. Now, I don't mean this as a political statement, this is just an observation. And that is 3 pieces of legislation that were passed under the Biden administration move us in the right direction. They're not perfect pieces of legislation because you have to deal with the Congress and you make political mistakes and so on. But we did have the Bipartisan Infrastructure Act, by the way, which skews towards red states and red counties because that's where the real deficit has been in public infrastructure spending. Number 2, we've had the CHIPS and Science Act, which is aimed at emphasizing just that, making us more independent with regard to a semiconductor manufacturer, but also general science. And number 3, we've had the so-called, this is really a misnamed, IRA, the Inflation Reduction Act, which invests, I don't want to call it just green energy, it's all kinds of alternative energy and other energy sources, including carbon, by the way. And it also includes, of course, keeping pharmaceutical prices under better control. So I look at these 3 pieces of legislation and I say, these are things in the right direction. And I would hope that whoever is elected would move us still in that direction, because to me, that's the way you handle a budget deficit.
Now, I want to come back to the deficit later, but you raised the question of growth, which truly is the most important thing. If we can't divide a pie that's not very big, that's not very interesting. And I want to get to AI in a moment, but in terms of a growth agenda, you mentioned support for basic research, which is usually what economists think of as what public policy could do to move the frontier. Any other things in the toolkit before we start talking about AI that you would think of as a growth-oriented policy, whether it's on the tax side, spending side, regulation, whatever it is?
Well, here I'm going to say something that will sound ideological, but I think it is based in history. And that is, I think that an economy to succeed, a capitalist economy like our own, requires good regulation. Not no regulation, good regulation, because you need to have guardrails. You need to have guardrails with regard to worker safety. You need to have guardrails with regard to the environment and so on. And by the way, it was Richard Nixon who put these first guardrails in place in our post-World War II environment, and who put them in place at the beginning of the 1900s. It was Teddy Roosevelt, a Republican president, who created the FDA, who did the first significant work in terms of the environment by creating the national parks, and also, by the way, created a more professional civil service. And if you ask me about one of the things I'm really concerned about, and this is going to sound political because it is, I think that the Trump proposals that come under the title of Schedule F would be an absolute disaster for our nation and our economy. Now, what do I mean by Schedule F? It's discussed in Project 2025, and as you know, former President Trump has disavowed it, saying he hasn't read it. I've read it. I wouldn't recommend it as nighttime reading, by the way. But you don't even have to believe Project 2025. In the last few weeks of Mr. Trump's term in office, he actually established something called Schedule F and is talking about reestablishing it under second term. Now, what is it? In our federal civil service, we have 10,000 people at the top These are the political appointees, and I believe every president is entitled to their political appointees. They have things that they want to get done, they have policies that they want to implement and so on, and they deserve their cadre of supporters who basically lead agencies. Under that 10,000 are 40,000 people who are civil service. These are people with expertise in science, expertise in the operation of various industries, expertise in the law, and so on. Under Schedule F, again, which was put in place when Mr. Trump was president the first time, those 40,000 jobs would be redesignated as political appointees. I want you to think about that for a moment. It means that within the 6 or 9 months that it would take to do so, its potential is that 40,000 people who have civil service approval, they've gone through all kinds of testing and procedures and so on to get their jobs and have years of experience, they would lose their jobs and they would be replaced by political appointees. Now, maybe some of those political appointees are knowledgeable, but there's no guarantee that they are. And I worry very much about having an economy in which we have political appointees making very important decisions. We had that before Teddy Roosevelt was president. It didn't work out so well. And I think the professionalization of our federal government, while not perfect, I know we can all point to things that are not being run the way we might like. It's certainly a lot better than having no guardrails at all.
Let me change the channel to talk about generative artificial intelligence. Economists generally view this as an example of a general purpose technology. You know, and there are many historical examples: internal combustion engine, electrification, mainframe computing, the internet. Each of those technologies wasn't just big on its own, it transformed the economy all around it. What do you see for productivity and for the economy of generative AI? You know, there's some who think this is going to revolutionize the world overnight, some who think it's just not going to have much of an effect, others who think it'll go slowly and then quickly. Where are you in that continuum?
Here again, Glenn, I am fortunate to have access to people who are really in the trenches on AI. I speak to computer scientists all the time, and I speak to people in various industries who are using AI. And one of the things that I would point to is that many companies in particular are standing up, raising their hands and saying, we're into AI. If you look at corporate reports, quarterly reports, for example, going back 2 years, 10% of companies said that they were investing heavily in AI. Now it's 40%. So we have seen certainly a very significant revolution in that regard. The second question, though, is what impact has it had so far? Has it benefited productivity? And the answer typically is no. The impact has been primarily on cost, which has gone up substantially, and also in terms of people trying to hire individuals who either have or proclaim some knowledge of AI. So I think we are very, very early days, which means, as you suggest, it's an open question in terms of how this is going to work out. Let me give you some of my thoughts. Number one, I do not think that, by the way, I have an undergraduate degree in computer science. All right, I don't want you to think I'm a Luddite, okay?
Me too, but they used punch cards in the days when I was a student.
Yeah, me too. No.
Okay.
I actually programmed the terminal access for our system. But in any event, ancient though it may be, my knowledge of computer science, I've been able to keep up because I get to chat to with people who know something. And I believe that we do not all need to get degrees in computer science. I believe that there will still be, obviously, demand for people very knowledgeable who know how to implement the systems. But to me, the real interesting thing for the economy overall and the labor force overall will be to become domain experts. So, for example, and Glenn, maybe you had the same experience I did. When I started, I was both an economist and a computer scientist. I was building my own models, right? I was doing my own programming. I was doing my own statistical analysis. And then, of course, I didn't have to, because the systems themselves became much more sophisticated, et cetera. And it was my domain expertise and knowledge of how to use those systems that really made the difference in my career. And I think an analogy for the next 10 years will be very similar to that. People who have domain expertise, whether it's business management or whatever it is you think is of interest to you, medicine, any other category, with using AI to augment what it is you're doing, not to replace it, but to make what you're doing easier and faster. That to me is what the next 10 years or so will look like. Where are there some exceptions? We've seen some very interesting applications in medicine with AI, and what they're basically doing is looking at the data. This has been very helpful in things like radiology, for example. But you know, we've both been in computer science. We've had AI for many years. We used to call it machine learning, right? It was machine learning. You basically just became more and more sophisticated in the use of the data. The difference now is the language models. And I think that the language models have shown themselves to be useful, but only if there is somebody, a real person, watching over them. Only if there's a labeler to look at the output and say, yeah, that makes sense. Or in cases other than that, like, that doesn't make sense. I know we've all heard about the story about the lawyer who submitted a brief to a court using AI, and it was thrown out because it cited cases that never existed. So you need to have some smarts about how you use this.
So better to be an MBA than data scientist. That's what I'm hearing.
Unless you love being a data scientist.
Well, I have one other follow-on on AI. When we went through globalization and technological change, we weren't really prepared for what it was going to do to the workforce, and we're paying the political economy price for that today. Are you worried that AI might lead to some of the same forces, or is that just overblown?
That clearly is something we need to be looking at. And my answer to that is we have to make sure that we bring along everybody that we can. One of the things that we had seen in the US economy is that even people at the lower end of the wage scale and the education scale in previous situations of technological advancement were able to benefit from it. Whether it was somebody doing a clerical responsibility in an office or somebody doing a warehouse responsibility, by using those tools, their productivity rose and it was possible to pay them more. That to me is sort of the golden ticket, and that would be the way I would like to see this work out. How do we do that? Part of it is a commitment in terms of training people properly to begin with and retraining people. And as I take a look at what many industries did mistakenly, in my view, over the last 20 or 30 years, rather than reskilling existing workers, they basically outsourced. And that didn't help us either in terms of supply chain, and it certainly didn't help the workers that were already in place.
Now, last line of questions from me, that's a hint for all of you to get ready with your questions. I want to return to the deficit. So go back to the beginning of our conversation, your Goldilocks economy. In that economy, we're running a $1.8 trillion budget deficit when nothing is really wrong in macro sense. And at the same time, as you noted, we have very large structural problems, some related to demography, others to rising healthcare costs, particularly in our programs for older Americans like Social Security and Medicare. And as we talked about, we're probably going to have to raise defense spending. Markets don't seem too worried about this. When I look at the 10-year yield, when I look at equity markets, so what are they seeing that we're not? How is this going to play out?
Okay, here's my preamble, and that is they're not worried now, but they will be at some point. And I don't know what the catalyst is going to be, but at some point, it will not be as easy as it is right now to finance that debt. Right now, there's no problem, right? Investors around the world want to buy Treasury securities. And with yields now at about 4%, even domestic investors want to buy Treasury securities. So there's no absence of demand. The question then becomes to identify a catalyst. At what point does either the deficit or debt become so large relative to GDP that investors say, I don't want to do this anymore? Or the yield becomes unattractive, and so investors are no longer willing to do it. I think that we have to consider a few things. Number one, what are the alternatives? What's going on in other economies around the world? One of the reasons there's been such strong demand for US Treasuries is because foreign investors like the depth and they like the liquidity of our Treasury markets, which is unsurpassed anywhere in the world. Number two, obviously related to that, is the dollar has been a good currency in which to invest. But there are demographic time bombs, not just here, but elsewhere. And I think it's important to recognize that in the federal budget, there's spending and there's spending. There's the spending, for example, on things like Medicare and Social Security that have some economic benefit. Obviously, they have economic benefit for the families receiving those payouts. But then there's spending which is really much more of an investment in the future. There's a higher multiplier effect. I think there's a higher multiplier effect by investing in young people, investing in people where the productivity can enhance, i.e. through education. I think that there's higher productivity enhancements and multiplier if you invest in the tools that people will use ultimately. And again, that's infrastructure. It's the science and so on. And so I think we need to distinguish between spending where there's not much extra bang for the buck versus the spending where there could be big bang for the buck. And to me, that's quite important. I also want to go back, if I may, to something that we lightly touched on, and that has to do with the pressure being felt by some middle-income families. And we particularly see that among young families who are early in family formation years. And I worry about this. I worry about the child care crisis in the United States, and it is a crisis. There just are not enough providers of those services. And what do we end up doing? We end up putting pressure on people who are not at the very beginning of their careers, but are on that slope up in terms of developing their careers and their earnings potential, and we're making it difficult for them to stay actively engaged in the workforce, and that's not really helping anybody. So that to me is a concern. Add on to that the worries about housing prices that I mentioned before, that for many young families, housing is in some cases unaffordable. So you have these pressure points that are related to can't work as much as I might like, and my expenses are high, and what do we do about that? Is there, and this to me is a political question, and that is it appropriate for the nation to undertake policies to make it easier for those families to get themselves established and to move forward?
Okay, I'm going to open it up to all of you. I'm going to ask the Chazen folks to help me because these lights are bright. Anybody with a quick question for Abby? Yeah. Right here, Michelle.
Question, Abby,
wait for a mic, please. Is there a...
You didn't ask about tariffs.
If we all lightning...
Abby, a quick question, a personal question. After your illustrious career, I'm sure you could have gone 200 miles north of here or on the West Coast, and yet here you are at Columbia Business School. I'd like to know why you chose Columbia Business School, and now that you have been here for a few months, what you found here, what you like, what you don't like, and what we could do better.
Wow. The simple answer as to why I'm at Columbia is Glenn. Several years ago, I had a conversation with Glenn. We were both involved in the Economic Club of New York. And I said, you know, I think I might like to teach. And Glenn said, if you do, come here. And I was introduced to the business school more than a decade ago. I was an adjunct. I would take a week of vacation from Goldman to teach here. When I decided to retire from Goldman Sachs a couple of years ago, a very lovely invitation was extended to me to be here. I love the students. I think that the international aspect of the student body is very appealing. I love the fact that people are coming from very different backgrounds. I admire that diversity of prior experience, both work-wise and person-wise. And it's been a great situation for me. And by the way, I like the faculty. There's some terrific people who are working here.
Another question, yeah. You got a mic there?
Hi, thank you. I have a question on the job. So you're you know, the data says that the jobs the job market is very strong. Anecdotally, like it seems different from the viewpoint of a student right now. And you go on LinkedIn, you'll see plenty of people who were laid off, who are looking for jobs.
Right.
Before the internship season, like people trying to get internships was very hard. And I think the job market seems from a student viewpoint to be very difficult. So I guess like there's an inconsistency there that I'm wondering if you have an opinion.
Sure. I think that's a terrific question, and I'm sure relevant for other people in the room. If you look at employment data in general, we always have to recognize that there's friction, right? We have to recognize that there may be lots of jobs out there, but there's always that friction with perhaps somebody losing a job or having difficulty finding a job. And where are we now? When we were coming out of the pandemic, at the best point for potential workers, there were more than 3 jobs for every potential worker, right? 3 jobs for every worker. That is extraordinary. We are now down to an historically robust 1 for 1. Now, it doesn't feel as good as 3 for 1, but it's still 1 for 1. The problem is the friction. The problem is finding the specific job for the individual. And clearly there are some categories where it is more difficult to find a position. I don't mean to suggest other than that. And one of the things that I think we also have to recognize is that there is less willingness on the part of some potential employers to go out and hire before they need people, right? Even before the pandemic, in certain industries, including financial services, there was often hiring that was done in anticipation of future need, often 1 to 2 years or longer into the future. I see much less of that now. So the positions that are being filled because they're needed, and they're needed almost in an immediate way. So I think that helps explain some of what you're feeling.
Let me try this side of the room. Haven't seen anybody over there? You
Somebody
got,
up
okay,
there.
Go for it. Thank you for sharing your insights with us. One comment in the conversation that stood out to me was that you mentioned the lack of regard for various social policies and programs since the 50s and 60s. Now, correct me if I'm wrong, but in my own words, neoliberalism. Is it coming to an end? What's the way out?
Yeah, what I was referring to specifically were a lot of the investment programs that were undertaken by the federal government. You know, coming out of the Second World War, there was a recognition and an acknowledgement, bipartisan, that there needed to be significant investment in the country. So, for example, one of the largest infrastructure programs ever undertaken in the United States was initiated by Dwight Eisenhower, the Republican president who had been the commander of Allied forces during the Second World War. And it was things, not just the interstate highway system that people talk about, but there were many other things that were invested in, including water systems throughout the country, bridges, et cetera. It was very wide-ranging. And in addition, there was significant funding provided by the federal government and then augmented by state and local for public school education. If you take a look around New York City and you see some of those school buildings, a lot of those are circa 1952, 1956, 1960, it's basically a situation where we used to invest heavily in that kind of infrastructure as a nation, and then we lowered it significantly. The federal government became less engaged, state and local governments, many of whom found themselves with budget issues, because remember, state and local governments can't borrow for more than, they can't run a deficit, right? The federal government can, state and local governments can't. So if you're the mayor of a city right now, and you see that the water system needs to be upgraded, and it's going to take 8 to 10 years on average, I'm not making that number up, by the way, it's 8 to 10 years, why would you spend your political capital to get it done if you're not going to be mayor in 8 to 10 years? So there's a reason why the American Society of Civil Engineers gave U.S. infrastructure a D- grade, right? D-. World's wealthiest nation shouldn't have a D-. By the way, we've recently upgraded to a D+. Still not great. So that was one. The other thing that I alluded to had to do with the huge increase in spending that is often referred to as post-Sputnik. Have you heard this expression? All right, if Sputnik was a Russian satellite, if you speak Russian, it's Sputnik, but it was post-Sputnik, and Americans got really scared that the Russians were able to launch a satellite ahead of the United States, even though the United States had a rocketry program in place. And there was a huge amount of spending. President Kennedy, Democrat, announces, we're going to the moon. And the amount of investment in NASA and related areas, bad pun, skyrocketed. But it stayed elevated for a couple of decades. And it was that investment in basic science that made a difference. Now, some people will say, well, wait a second, it doesn't have to all come from the federal government. And I would ask you to think about this. If you look at the research budgets of corporations in the United States, they're not doing basic science. They're not doing the sort of science where you test a null hypothesis, and maybe you're right and maybe you're wrong, because they don't want to take the chance of spending money on something that's not going to work out. What companies do is they don't do basic science, they're doing applied science. They're trying to build a product that will make money, right? And one of the things that we've seen is as the federal budget for spending on science has gone down, the corporate budget has gone up. The corporate budget has been increasingly concentrated only in successful companies because they've got the money to invest in their future growth for specific products, and it's basically in 3 industries. 3 industries account for 65% of that spending. And we all know what they are, right? It's IT software, IT hardware, and pharmaceuticals. And all these other American industries that used to get basic science funding are nowheresville. They're all like single digit. That to me is a mistake. It helps explain why we've lost primacy in several other industries. So I believe that we really need to emphasize again our investments in these categories. People here in the business school who've heard me lecture on this topic know that I will use the following data points. For decades, the United States was #1 in investment in these categories. #1, not just in terms of dollars. We're a large economy, so we can afford more, but as a percentage of GDP and federal budget. We were #1. Do you know where we are now? We're #12 in the world. #12. That's an embarrassment. And it's because we have gone down, but also other nations, including China, have decided that it's important for their future growth to invest heavily in this category. And we're lagging behind in several areas because of it.
I want to do moderator prerogative just for a quick interjection and
Sure.
a quick follow-on question for you. So does neoliberalism have a future? Yes, it does. I wrote an essay last summer called Markets for the People in National Affairs. So that's at least one person's take on neoliberalism. But my question for you, because you mentioned tariffs and he mentioned this question, is globalization dead?
If you look at corporate data, the answer is no. That there is still, even in the federal data and the national data, around the world, by the way, there's still a lot of foreign trade going on. It's just being redirected. So, for example, we've had not just, we'll call it nearshoring and friendshoring, right? We're not importing as much from China, we like to say, but we're importing it from Chinese companies that are building this stuff in Mexico or other parts of Latin America. And so when you look at it, what we're seeing is companies are trying to improve their supply chains, but they're not necessarily bringing everything back here. So it's a bit of a misnomer. Many people still believe in comparative advantage, and we see decisions being made that way. And I will basically jump to the discussion about tariffs, if I may. I think everyone here is aware of the fact that a tariff is not paid by the country on which it is imposed, right? If we have a 10% tariff on Chinese exports, China's not paying that. Ultimately, U.S. consumers are. It's a sales tax that gets paid here. And one of the things that has been very interesting is to look at the economic analysis that gets done in terms of what the next consequences are, the second round consequences of a tariff. And the impact is very significant, particularly on our trade partners. If in fact you have our friendly trade partners, if you have a 10% tariff across the board, who gets hurt the most? Our most important trade partners are our buddy neighbors here in Canada and Mexico. So we add a sales tax onto our consumers, and if the tariff works as the implementers want it to work, you would actually see a very significant hit to GDP in Canada and Mexico. We'd also see, based upon the trade patterns for the United States, we'd see a big hit in Europe as well. And as I mentioned at the outset, our friends in Europe, who, by the way, are our military allies as well, they are already teetering on the edge of recession, and tariffs would be extremely damaging to them.
Okay, let me go back to your questions. Yeah, right here. Is there a mic? This gentleman?
Yes, thank you. You spoke about Europe and global economics a few times. I have a question about Europe specifically in the sense of, do you think the European budgetary rules that they have at the moment are there for good? Are they still in place, with France now obviously having quite a large deficit? And do you think that those issues in Europe and China will also then in turn have a big effect on the States?
Are we referring to the rules that created the European Union? The Maastricht rewards?
Now the deficit rules that they have the 3% limit that France is exceeding, and then again there are 110%, I think, debt compared to GDP.
Yeah. You know, the creation of the European Union basically included these things that started with the Maastricht, which basically says, look, everybody has to keep their budget deficit within a certain level and so on. This is something that was not really carried in full during the pandemic. There was plenty of fiscal stimulus that was provided. By the way, not as effectively as it was here. The approach was very different and turns out not to have worked quite as well. And Europe is suffering from a variety of things. Number one, the demographics are problematic. We see the aging there as well, and it's in some cases worse than it is in the United States because the birth rate is lower in Europe. And they've not been as welcoming to immigrants. You know, we have benefited greatly in the United States with regard to our population growth because of immigrants. Pre-pandemic, 60% of the increase in our workforce in the United States in the prior 10 years was immigrants. If that immigration flow slows, that is problematic. Europe, with the exception of Germany, has not welcomed immigrants in recent years. That has also contributed to more sluggish economic activity. As Glenn pointed out before, Europeans will be among those who will probably need to increase their defense spending. So they have this really uncomfortable kind of balance. And add on to that, that if I think we've not invested here in the United States as a nation sufficiently in a bunch of industries, the Europeans have done an even worse job. Many of those economies are very poorly diversified. In some cases, they are not basically investing satisfactorily in those industries, so it creates a problem. There are some exceptions, right? The Scandinavian nations have followed an industrial policy saying, we want to be tech-oriented, telecom-oriented, and they have made it easier to go to university. And they have also done a lot of basic science research funding for their universities. By the way, you see the same thing in South Korea. But the larger nations in Europe have to be watched very carefully. One other exception is the UK. As it is having this slow, mild, subterranean exit from Brexit, they're doing better.
I want to have one quick last question and quick answer. If you have a mic down in the front.
Thank you. Abby, thank you so much for this conversation with us. I just wanted to ask you, we're all very excited about the potential for AI, but it hasn't escaped any of us that the power to do good is often outweighed by the power to do bad. And since you're not a Luddite, how can you advise the current generation as we plan out the new world that AI will create for us? How can we set in guardrails? How can we set in value sets that will create a better world than the world of the past?
Yeah. Lulu, that is such a difficult question. Thanks for asking it, right? Let me try to take a stab at it. First of all, we as a nation here in the United States, we've not done a good job in terms of putting appropriate guardrails. And look, I'm not looking to tether anything, but appropriate protective guardrails around any of the more recent technologies. Internet, we still haven't figured out. You know, the Congress still hasn't figured out what they want to do. We don't have the same sort of protections that they have in Europe with regard to privacy and so on. And as we see what's happening with social media, where disinformation, misinformation campaigns have become dominant, and really hateful algorithms have become dominant, we've done a pretty lousy job there as well. So I am concerned about this area. And one of the things I would have liked to have believed is that the companies themselves would be good global citizens. And what we have seen is that that's not the case. Even some of those that started in AI as not-for-profit entities have proven themselves to be profitable not-for-profit. And they really have been focusing on things like their own market share and their own market control. I do believe that this is an area that requires a lot more attention and something that I personally, quite frankly, don't feel equipped to answer because I don't know that we have established any good model for it yet. Didn't do it in internet, didn't do it in privacy. AI, we have another chance. Presumably, according to many, this could be even more, a greater consequence, and we need to get our act together on this.
I'm going to steal 1 minute for your lunch for a quick lightning round. It's 2025, after the election. The biggest surprise we'll see, and is your comment about Harris, Trump, or both?
I don't understand.
What surprise are we going to have after the election?
Depending on which one is which?
Yeah.
Okay. I think that one of the surprises, if it is Harris, is that we'll find that she's very middle of the road, and in some ways actually quite conservative. I think that much will depend upon her advisors, and her advisors that I have seen in things like economics and so on are actually very, I don't want to call them conservative, like a small c, but they're thoughtful and, if you will, not neoliberal. Mr. Trump, I have to say, is a total wild card.
So it's all a surprise.
It's all a surprise, and what we learned in the first term, it was often a surprise to the people who worked with him in the White House.
Okay, you heard it here first. Join me in thanking Abby Joseph Cohen.